Tomorrow morning, the world's largest physical gold market goes dark. Not for maintenance, not for a technical glitch. For a holiday. 8 full trading days without the country that mines more gold than Australia, Russia, and the United States combined. Without the central bank that just bought gold for 15 consecutive months. Without the nation that controls somewhere between 60 and 70% of the world's refined silver output. 8 days where the second largest economy on Earth simply stops participating. And we're doing this with silver inventories at levels that make January's 35% single-day crash look like a practice run. The last time Asian liquidity evaporated this completely, silver had its worst day in recorded history. Gold dropped 12% in a session. Margin calls cascaded. Algorithms went haywire. By the time New York traders arrived at their desks, the carnage was already complete. That was 3 weeks ago. Now, we're about to find out if these markets can survive without their largest player. In the thinnest liquidity environment of the year, 12 days before the March COMEX delivery deadline. With inventory numbers that don't quite add up, this isn't a prediction video. This is a roadmap for the most dangerous trading week of 2026. Let me show you what actually happens when China goes offline. Here's what most people miss about Chinese Lunar New Year. It's not just that China closes, it's that the entire Asian price discovery mechanism shuts down. The physical backbone of the precious metals market essentially vanishes for over a week. Think about what that means. Shanghai Gold Exchange handles enormous physical volume. Real metal, real buyers, real settlement. When it closes, price discovery shifts entirely to London and New York. And here's the uncomfortable part. London and New York are primarily paper markets. COMEX futures, LBMA forwards, over-the-counter derivatives, financial instruments that reference gold and silver, but rarely involve anyone actually taking delivery of metal. The physical market goes to sleep. The paper market stays awake. And those two things don't always agree on what gold and silver should be worth. In a normal week, this might create a small divergence, a few dollars here or there. But we're not in a normal week. We're entering this period with COMEX registered silver at 103 million ounces, open interest representing 4 to 500 million ounces, and a delivery deadline approaching faster than most people realize. Let me put that ratio in perspective. If even 20% of open interest holders decide they actually want physical metal, COMEX would need to deliver 100 million ounces. They have 103 million registered. That's a margin of 3 million ounces, 3% cushion. In China, the world's dominant silver refiner will be completely offline while this plays out. You starting to see the problem? Let's talk about liquidity for a second. Not the textbook definition, the real version. Liquidity means there's someone on the other side of your trade. You want to sell, someone wants to buy. You want to buy, someone wants to sell. The market absorbs your order without the price moving dramatically. Deep liquidity means you can move $50 million without causing a ripple. Thin liquidity means a $10 million order creates a wave. Now imagine what happens when the world's largest buyer of physical gold and the world's largest refiner of silver just stops showing up. The bid-ask spread, that tiny gap between what buyers will pay and sellers will accept, starts widening. In normal conditions, you might see a $1 or $2 spread on gold. During periods of thin liquidity, that can balloon to $5, $10, even $15. That's not just inconvenient. That's expensive. That's risk. But here's where it gets interesting. In a market with deep liquidity, large orders get absorbed. The market makers, the big banks, the institutions, they step in. They provide the other side. They stabilize price. In a thin market, those same players step back. Why? Because there's no one behind them to offload risk to. If they buy $100 million worth of gold futures and can't immediately hedge that position in the physical market because Shanghai is closed, they're naked, exposed, so they widen their spreads, they reduce their size, they wait. And into that vacuum, algorithms arrive. Algorithms designed to detect exactly this kind of environment. Thin order books, wide spreads, reduced market maker participation. And they do what algorithms do. They exploit it. A sell order hits. Price drops. Algorithm detects the move and sells more. Price drops further. Stop losses trigger more selling. Margin calls more selling. It's a cascade. And it happens fast. This is what happened on January 30th. Let's revisit that day for a moment. Silver opened around $115. By the session close, it had touched 71. A 35% decline in one trading day. The worst single-day drop in silver's history. Worse than the Hunt brothers collapse in 1980. Worse than the 2008 financial crisis. Worse than any coordinated manipulation theory anyone had ever proposed. Gold fell 12% in the same session. The largest single-day percentage drop in over 40 years. The narrative was simple. Kevin Walsh got nominated for Fed chair. Markets freaked out. Precious metals sold off. But that's not what actually happened. Here's what actually happened. In the days leading up to January 30th, Chinese traders were already preparing for Lunar New Year. Liquidity was starting to thin, and on January 29th, CME Group, the entity that runs COMEX, hiked margin requirements. Gold margins went from 6% to 8%, silver from 11 to 15%. Now, if you're trading on margin, that doesn't sound catastrophic. A few percentage points? Big deal. Except when you're leveraged 10 or 20 to 1, a 4 percentage point increase in margin requirements means you need to post 30 or 40% more capital. Immediately, most traders don't have that capital sitting idle, so they have two choices: deposit more money or close positions. And in a thin market, when everyone tries to close positions at once, there's no one to sell to, so price collapses. 1.8 billion ounces of paper silver traded on COMEX that day. Let that sink in. 1.8 billion ounces. That's more than 2 years of global mine production, traded in a single session. Most of those contracts were opened and closed within hours. Dump paper, crash price, exit. The crash started in Asian hours when liquidity was already compromised. It accelerated in London when European traders woke up to chaos. By the time New York opened, it was over. And here's the part that should make you uncomfortable. The physical market never moved. Bullion dealers didn't see a flood of sell orders. Mints didn't stop selling coins. Refiners didn't report increased supply. The actual physical metal that people hold in their hands or store in vaults just sat there. Only the paper market exploded, which tells you something important about what these markets actually are. Now, let's talk about why China specifically matters. China isn't just another participant in precious metals markets. China is the participant. They mine 370 tons of gold annually, more than the next 3 countries combined. They import over 1,000 tons. They consume more than any other nation. And their central bank, the People's Bank of China, has been buying gold every single month for over a year. 40,000 ounces in January alone. Total reserves now sit at 74 million ounces. And this isn't speculation. This isn't retail FOMO. This is a sovereign state systematically diversifying away from U.S. Treasury holdings. China has cut their Treasury position by 11% this year, $682 billion remaining, while simultaneously expanding gold reserves. That's not a trade, that's a strategy. On the silver side, China controls the refining infrastructure. 60 to 70% of global refined silver output comes from China. And on January 1st of this year, they implemented new export restrictions. Only refiners with annual capacity above 80 tons can export. That immediately cut hundreds of smaller operations out of the global supply chain. China is quietly hoarding silver domestically while restricting exports. And most people haven't noticed because the financial media doesn't cover refinery export licensing requirements. So when China closes for Lunar New Year, it's not like Japan closing, or Europe going on holiday. It's the physical market's central nervous system going offline. And we're about to spend 8 days finding out what happens when you remove the central nervous system from a market. Here's exactly how this unfolds. Tomorrow, Monday, February 16th, is Lunar New Year Eve. Shanghai closes. Hong Kong and Singapore have half-day trading. That's the last gasp of Asian participation before the blackout. Tuesday, February 17th, the Year of the Horse begins. Mainland China markets close and stay closed through Monday, February 23rd. 8 consecutive trading days. Hong Kong is fully dark Tuesday through Thursday. Singapore closes Tuesday and Wednesday. Shanghai Gold Exchange doesn't reopen until Tuesday, February 24th. Now, here's what that calendar means in practice. Wednesday, February 18th, we get FOMC minutes, the Federal Reserve's internal discussion notes from their last meeting. If those minutes reveal disagreement about rate policy or hint at faster cuts than markets expect, that's a catalyst. Normally, FOMC minutes might move gold $10 or $20. In a market with no Asian liquidity to absorb the flow, they could move gold 50 to 100. Thursday, February 19th, initial jobless claims. If unemployment claims spike unexpectedly, it supports the rate cut narrative. Gold rallies. But in thin liquidity, it doesn't rally reasonably, it overshoots. If claims drop, gold sells off. But again, it oversells. Every move gets exaggerated by a factor of 2 or 3 because there's no depth to absorb the orders. Friday, February 20th, Hong Kong reopens. This is critical. When Hong Kong traders come back, they either validate the prior week's price action or they reject it. If Hong Kong opens and gold holds steady or rallies, it confirms that Asia agrees with Western valuation. If Hong Kong opens and immediately sells off, it signals that Western markets got ahead of themselves. Then Saturday and Sunday, markets are closed. But this is when institutional traders prepare for the final sprint. They check COMEX inventory reports. They analyze open interest changes. They look at physical dealer premiums. Monday, February 23rd, last day of Chinese closure. By now, we're 4 days from March 1st notice day, the deadline where COMEX contract holders must declare whether they want cash settlement or physical delivery. Traders who don't want to hold through delivery start closing March contracts and rolling to May or July. If open interest collapses, the squeeze theory dies. If it holds steady or increases, the pressure intensifies. Tuesday, February 24th, China reopens. This is the moment of truth. If Chinese buyers immediately start accumulating, it validates the bullish case and could trigger a fear of missing out rally. If they come back and sell, it signals they spent the holiday reassessing and don't like what they see at current prices. And all of this is happening while COMEX registered silver inventory continues draining. Let's do some uncomfortable math. COMEX currently has 103 million ounces of registered silver. That's metal available for delivery. March open interest represents 400 to 500 million ounces. Most of that will settle in cash. People trade the contracts. They don't want actual silver bars, but some will demand delivery. In January, roughly 40 to 50 million ounces stood for delivery. That's unusual, but manageable. COMEX delivered, the system worked. Barely. Here's the interesting detail. JP Morgan issued 99% of those deliveries. One bank, 8.1 million ounces, 1,624 contracts, 99%. That's not a free market. That's controlled distribution. JP Morgan is essentially managing inventory flow to prevent chaotic default. They're the designated market stabilizer. But what happens if March delivery demand hits 80 or 100 million ounces? Can JP Morgan source that much metal in a market where China just spent 8 days offline and global physical premiums are elevated? Nobody knows, because it's never happened before. Now, layer in the drainage rate. Registered inventory has been declining at roughly 785,000 ounces per day. Over 8 days of Lunar New Year, that's 6.28 million ounces drained. If the rate continues, by the time China reopens, registered inventory could be at 96 or 97 million ounces. Then 3 more trading days until first notice day on February 27th. Another 2.35 million ounces drained. We're looking at 93 to 94 million ounces registered when delivery intentions get declared. If 50 million ounces stand for delivery, COMEX delivers and we're left with 43 to 54 million for the April contract. Still tight, but survivable. If 80 to 100 million ounces stand for delivery because physical buyers smell blood, the system doesn't have enough metal. What happens then is anyone's guess. Does COMEX change the rules? Do they cash settle contracts that demanded physical? Do they force majeure and suspend delivery obligations? Or does JP Morgan somehow source another 30 or 40 million ounces from global stockpiles during a holiday week when the world's largest refiner is offline? This is the scenario that keeps commodity desks awake at night. There are 3 realistic ways this week resolves. Scenario 1, orderly consolidation. Gold trades between 4,950 and 5,100. Silver stays between 76 and 81. Volume is light, volatility elevated but contained. FOMC minutes are neutral. Jobs data comes in as expected. Hong Kong validates the range when it reopens Friday. China returns Tuesday without disruption. We drift into first notice day without drama. March deliveries settle at manageable levels. The system survives. Markets move on. Probability, maybe 40%. Scenario 2, bullish breakout. Friday's CPI momentum continues. Gold breaks above 5,100 and tests 5,150 to 5,200. Silver reclaims 81 and pushes to 84.85. Physical buyers front-run the March delivery squeeze. FOMC minutes hint at faster rate cuts. Jobs data weakens. Real yields fall. Hong Kong comes back bullish. China reopens and resumes buying. We enter first notice day with strong momentum and elevated delivery risk. The squeeze narrative intensifies. Financial media starts covering it. Retail piles in. Probability, 30%. Scenario 3, flash crash redux. Someone dumps a large position in Asian hours when there's no bid. Algorithms detect thin liquidity and pile on. Stop losses cascade. Margin calls trigger forced liquidations. Gold breaks 4,900 and tests 4,850 or lower. Silver crashes to 72, 74, or worse. It's January 30th again, but spread over 8 days instead of one session. FOMC minutes turn hawkish. Jobs data surprises to the upside. Dollar rallies. Hong Kong sells off. China returns and doesn't support prices. We go into first notice day with weak hands shaken out and open interest collapsing. The squeeze theory dies. Probability, 30%. Notice something about those probabilities? They don't add up to certainty in any direction. That's because the setup is genuinely binary. Liquidity either holds or it breaks. There's very little middle ground. Let's zoom out for a second. What we're really watching this week isn't just about gold and silver prices. It's about market structure. These markets exist in 2 parallel universes. There's the physical market where actual metal changes hands, and there's the paper market where contracts, derivatives, and financial instruments trade at volume levels that dwarf physical supply. Most of the time, those 2 universes stay synchronized. Paper prices reflect physical fundamentals. Physical premiums stay reasonable. The system works. But during periods of thin liquidity, those universes can diverge. Paper markets can crash while physical markets barely flinch, or paper markets can rally while physical dealers struggle to source metal. January 30th showed us the crash version. 1.8 billion ounces traded on paper. Physical market didn't move. This week, we might see the opposite. If physical buyers decide to accumulate before March delivery and Asian liquidity is offline, they can spike prices in a thin paper market. A $100 million buy order in normal conditions might move silver $1 or $2. In this environment, it could move at 10. The fundamental case for precious metals hasn't changed. Central banks are still buying 60 tons of gold per month. Fiscal deficits remain at $2 trillion annually. Debt service costs hit $1 trillion. Real yields are falling. The dollar is weakening. Industrial silver demand continues exceeding mine supply for the 6th consecutive year. $19 billion flowed into gold ETFs in January, the strongest month on record. Wall Street analysts have price targets at $6,000 to $6,300 for gold. The macro story is intact, but short-term liquidity is king, and we're about to have 8 days without the king.